Hello, ladies and gentlemen. It's time for our modern investing show on Pod TV. My name is Sasha Star, and our guests for today are Dr. Milan Somberg. Welcome to the show.
Delighted to be here. Thank you for inviting me.
Thank you. And Jim Ida from Ida Foundation. Welcome to the show, Jim.
Thank you, Sasha. It's my pleasure.
Thank you. Let's look at the market today and what's happening. It's a big down day today. The catalyst is, of course, banking concerns. Um, I was really trying in the last few days to figure out really what's happening is, and there are not too many news about this Silicon Valley Bank issue, same as Signature Bank, especially the first one, the Silicon Valley Bank, is that the situation is that it's somewhat unusual, a bank which was taking huge deposits from startups in California, venture capitalists, and so what they were saying, like 2020, 2021, they were fantastic time when interest rates were extremely low, probably like never before. So what they were doing is when they were taking millions, if not hundreds of millions of dollars in deposits, they had to place them somewhere. And what they were doing, they were going into long treasuries, 30 years old treasuries. So when the interest rates started to go higher and higher and higher, from what I've learned until even a few months ago, so 8, 10 months ago, they didn't have a risk manager in this bank. So essentially, they, although most of these people running this bank, they had banking experience of all kinds and so on, but without risk managers, it's very difficult to see how they could oversee and calculate the risk what they were taking, because with every 25 basic point rates going higher, that bank was losing $1 billion. So if you calculate that the rates would go from 0 to 25 basic points in a very short period of time to 4, you're talking about right there, billions and billions, close to $20 billion was wiped out just right there. So now another thing what contributed to that they had some key investors from venture capital. I can name one. For example, you're all familiar with Peter Thiel. When he could estimate, and they're not isolated. Somebody like Peter Thiel is a very influential person who has several startups and several venture capitalists associated, and he would tell that, well, I have my doubts about the solvency of, say, Silicon Valley Bank. And they would all run at the same time, removing from the bank billions of dollars in very short period of time. We're talking about like hours, maybe day. No bank could withstand that. Even if you're talking about very solid Canadian banks, let's see Royal Bank of Canada, for example, or CIBC, it's been calculated that if only 2% of the depositors would ask their deposits back all simultaneously in one day, that bank would go belly up. So how you can compare Silicon Valley Bank with the Royal Bank of Canada, for example? It's impossible. And if you remember history, in the crisis of 2008, the Canadian banks were almost unaffected by that event. Yeah, their shares went down somewhat, but fundamentally they were unaffected by this event. But it's very different banking system in Canada and United States, where they have proliferation of small regional banks or so on. And for example, even authorities like, for example, governor of bank in California, they couldn't foresee what's happened there. So they didn't put their usual systems in place because they considered that to be a flagship of venture capital banks with so many well-known investors and startup capitals and so on. So anyways, a decision to mitigate that on Sunday, not even waiting for Monday opening, there were a decision to prop up the deposits, not only those insured up to $250,000, but 100% of the deposits would be returned with no cost to taxpayers because they would come from the pledge of all their long-term paper at cost, not at what it's worth today, but at cost when it was taken. So that would guarantee a return in 1 year, for example. So everything would return to normal. Did that return to normal? Monday was okay. Tuesday was hesitation. And today there were talk about Credit Suisse bank problems or so on. So the situation is what it is now today. All the market went down. Many stocks normally not associated with the bank, even those stocks went down. Although I must say, for example, one stock that I have, Unity Software Inc., symbol U, it's up 1.2% today.
Yippee.
Yeah, actually, for me, it would be better if it would go down simply because my position is covered by covered calls. So I would have an opportunity to buy them back at lower price than I sold, but that's not happening. The shares are doing quite well so far. And on the other hand, Lululemon, which I have, that was affected for one reason or the other. Just like everything else that went down today, that position also is insured. I sold covered calls against that position, but so far it's just standing there. I sold them at a very large premium. I sold covered calls. Each one generated 16.55, so $1,655 for each call that I sold. So it's 5 calls. That's what I got. And we'll see. I have a long time to expiration, so I still hope that shares will go higher in price. But just as precaution, I sold covered calls in that position too. Another position I initiated was bank, Chilean bank. It's a Banco de Chile, and that actually tomorrow it's a dividend day. So if you buy the shares today, you're still eligible for dividends. And the dividends, they're paying more than 9.5%. And so far, that bank didn't even go lower in price. I bought it around $28, and it's now $20.20. So it's almost there. And with dividends like that, 9.5%, I thought that that should be pretty good bet. Also, okay, I have shares of AMD. It didn't move much at all. My price was $86. It's trading now $86.97. Also, I sold covered call with expiration on March 31. I sold 88 call, got premium of $2.76. So that's quite secure position in my opinion. So that's about it. I don't have many shares or some option positions except those that I just told you. Now, I know what you're going to say. Milan, please tell me what's your outlook on this.
Well, first of all, I'd just like to ask you, Sasha, that high dividend rate that the Bank of Chile is paying must be associated with high risk. High returns and high risk always go hand in hand. What is the risk of owning a Chilean bank? By the way, as an aside, no Canadian bank in history has ever folded, not one.
That's right.
In the meanwhile, American banks, I bet 10 a year or more, are folding. Small mom-and-pop operations that have just a couple of branches, but nevertheless, failure of American banks is a pretty regular event. None has ever happened in Canada. But the question for you is, what is the risk of owning these Chilean Bank of Chile shares?
Well, the best way to look at it is take, say, 1 year chart and see what it was doing during the year. So if you take a year ago, it was $21.08. The lowest point was $17.43. The highest point was $22. So it's sort of in a trading range. It doesn't fluctuate that much. The dividend is quite solid and is being paid the same thing for. Actually, they even increased the dividend recently. Um, is there a risk involved? Absolutely. How could you say that there is no risk? However, Chile is a premier economy of South America, and this bank is one of the premier banks in Chile. That's the name Banco de Chile. And although there is a risk, but I think that if in 1 year you will get back, say, 9.5% of your money is invested. So already your cost is substantially lower than what I paid, say, $21. So almost 10%. So let's give or take $2 I will get in dividends, unless it will just go the way the Silicon Valley Bank. The likelihood of that is, in my opinion,
The Chilean economy is controlled by the Americans to a huge extent. Salvador Allende was the only communist government ever to be elected in a free election. All communist governments ever got in there by force. Salvador Allende was elected in a democratic election. So the first thing that he did is what all communist regimes do is they nationalized all sorts of things.
okay.
And the United States had many holdings in there, Anaconda Copper and other copper mines, a large number of copper mines. So they engineered to see Salvador Allende kicked out of there, and they put in Augusto Pinochet, who was a criminal and a crook of the first order. And many people disappeared. And the mothers of these people still now, 30 years later, are asking, where are my children? The number of disappeared people. So the Americans were able to engineer that, and the Americans control the Chilean economy to a large extent.
A couple of corrections. First of all, what you are talking about, it was not 30 years ago, but rather 50 years ago.
50, okay.
So we are talking about almost, now we can talk about Napoleonic Wars, we can talk about expeditions of Columb discovering America and many other wonderful things. But I'm looking at situation in a practical way, what's happening today. The Chilean economy is booming and is by far the best run economy in South America. So as the best of the best, that bank represents that economy. So if it's run by American interests, I don't see a big problem with that. In fact,
it's not a problem. It's probably a positive. Anyway, you asked me what my take is on the present situation.
Okay.
Throughout history, bank failures have always been associated with a fall and a drop in the stock market. So at 10:30 this morning, the American market was down about 1.25%, the Canadian market down 1.82%. But over the last year, both of those markets are down nearly 10%, which we see as a perfect buying opportunities. When markets drop, people run for the doors. The same people who would go out of their way to get a dozen eggs for 10 cents less, the same people who shop carefully when they buy a car or anything else, when the market is a bargain, they run. So now what you have is huge volume. The market is tanking when the people should be buying bargains the way they would buy their dozen eggs at a lower cost. They're running for the doors in huge volumes, which people with our mindset, with our approach to investing, see as a buying opportunity. At the other end, of course, when the markets are expensive, people are jumping on board, whereas our members are taking profit. So now, when you take a look at the headlines, David Ogilvy wrote a book in the 60s called The Confessions of an Advertising Man. And he apologized to his sister in that book for going into advertising, which was seen as a low-class, sleazy kind of operation. And in those days, advertising consisted of just giving out your contact information and what your company did. That's all it did. Today, advertising is designed to persuade, to get people to open their wallets. So that's what advertising is today. But so according to David Ogilvy, if you look at headlines alone, you got 80% of the information that that article has to deal with. So when I take a look at the headlines in the Wall Street Journal about half an hour ago, investor anxiety hits fever pitch after Silicon Valley Bank collapse. Market stress snarls trading in U.S. Treasuries. First Republic downgraded. Credit Suisse plunges as bank storm spreads up to Europe. Banks resume sell-off after Credit Suisse sharp drop, and so on and so forth. So those are the headlines, and they're telling you 80% of what you need to know. You don't need to read the article itself, the headline itself, according to David Ogilvy, will give you most of what the article contains. So people are running for the doors when really they should be buying bargains. You know, in 1994, I think it was long-term capital management, which was involved two Nobel Prize winning economists tanked to the tune of nearly $4 billion and needed 14 financial institutions to bail it out in order to prevent market panic. So we are just about there today. The American economy is going to continue being the strongest economy in history for quite a while. So betting on America is the place to be. And so that's what we say to our members, and that's what our members do. You know, we did a survey of our members to see how many of them were glad to see market dropping, and many were glad to see market dropping because they could buy bargains. They were also happy to see market rising because they could take profits. Always a winner. No such a thing as a bad market, except the market fluctuates sometimes as much as 30% in 1 year. And so people who are fully invested will absolutely find themselves having to sell at a loss in order to meet their needs. So the money that we will need in the next 3-4 years or so does not belong in the market because of that fluctuation. But that money that we do have in the market will make more than any other investment that's available. That figures show that. Unless you cherry pick. You know, if you cherry pick, say, San Francisco real estate will look better than the market. But if you do that, then you should cherry pick the market, in which case you see things like Facebook and Amazon and Apple and Netflix and Google and Tesla. They're all doing better than the market. You can only find them with hindsight. My hindsight, like everybody else, is 2020. Foresight, I'm not so sure. So that's my take. Time to buy.
Okay, Jim, what's your view on the market and how are you doing these days?
Well, I have always been a contrarian, as you know, Sasha, and that
Yes.
means when everybody is getting out of the market, I want to get in. And when everyone is getting into the market, I want to get out. So much of what Milan said is registering with me as my philosophy. But specifically about the banks, you know, people talk about recessions now as if it's the worst thing that could happen. But generations before ours were accustomed to what they called panics. And these were runs on banks, and these were when everybody lost their life savings. The people who survived those times. But what happened was that we began to pass regulations that required banks, people holding monies, to have some sort of reasonable chance of survival if there was a run on a particular bank. So they had to have cash reserves, things like that. And so these regulations stopped this wave of cycles of panics and recovery, that the 19th century America experienced quite regularly. And yet in 2008, we had a massive deregulation following the Reagan years and throughout the 90s. And again, the housing market and the banks and everything was a crisis again, almost a panic. It was so bad. And, so then we passed, in the United States, we passed Dodd-Frank's. So it meant to shore up some of these financial institutions. But gradually, after 2008, people again, the cry of deregulation started to play well in the halls of Congress, and they started to take away all the Dodd-Frank put in terms of regulations in order to make sure that the financial institutions were stable and could survive. And so now we find these banks on the verge of failure, and in the case of Silicon Valley Bank, failing. It is because of the lack of regulations that require them to have financial stability and be able to survive. And I have a story about Silicon Valley Bank, Magnus Carlson. I can't go for a walk without passing a venture capitalist where I live. And Silicon Bank had Magnus Carlson come in, and I was invited to attend. And it was a really kind of a very, I never get invited to these types of things, but it was only because it was the chess connection that I did. And it was a very high powered atmosphere. And so Silicon Bank going from that to, being out of existence in a very short amount of period of time, 5 years, it's kind of hard to put my head around that. But it happened. And it happened because people do, when they deregulate, all of a sudden they add in risk. And this risk is not managed well in many cases if it's just left up to the individual institutions. So I'm afraid, I know that this makes a lot of people that are Milton Friedman advocates cringe to say, but it does require regulation if you're going to have trust. And what we're seeing in the market now is a breakdown in trust. And people say, and I knew my parents and my grandparents' generations that didn't want to put their money in banks because they didn't trust the banks.
Yeah.
I'm sure
they would trust the mattress.
Yes, put it under your mattress is what they said. And so now that's a lack of trust is what we're seeing. And are we going to be able to rebuild that trust is the open question. I am optimistic that we will, and I am not going to disinvest from the market, but I do think it is a buying opportunity when people panic. I'm sorry to take advantage of it.
I'm surprised actually that the panic is so large because this bank and Signature Bank, they're not really that widely popular, and they're very on a percentage basis.
That's true.
You take the depositors there, it's minuscule. It's not even 0.1%, not even 100% of depositors. It's probably way less than that. So we'll see. I think the time is required to fix this slowly but surely. Probably by the next week, market maybe in different mood, but right now it goes one way. It's all the way down, unfortunately. And so now the question is whether to start buying now or wait a little bit. In my opinion, there was no capitulation on the market. There are still stocks that are going higher. For example, high-tech issues, like I mentioned, that Unity Software or AMD, it's much better, well-known company. They're going nowhere but higher, even in a day like today. So there is no panic yet. And when people still have some red, some greens, okay, so these stocks will go higher, and so I will cover losses from my red stocks and so on. So there is no panic, there is no capitulation, and there has to be a trigger to complete washout on very large volume. People are selling because of the margin calls, because of a variety of different reasons. It's just not there. So, and I said the same thing last year. There was no capitulation. And stock went down almost of the year. In October, it started to move much higher very quickly. So there was a lot of uncertainties in the market. And I remember a case which I quoted a few times when Nortel was $120 a share and went down very quickly to $60. And a friend of mine wanted to take a second
bargain,
and buy as much Nortel as he can. And I asked him if it could go from 120 to 60. What makes you think that it will not go down to 55? And if it will go down to 55, you'll get much better deals than now at 60. We know then what's happened, went down to pennies and then disappeared. So, well, S&P, of course, will not disappear. But in classic scenario, it has to go down. It has to form a base. then it has to slowly start rising. And
What Jim was talking about earlier was the reserve requirements of banks, which, if you take a look at the reserve requirements in different countries, they're getting to be smaller and smaller. And the situation is getting increasingly more dangerous. But the Federal Deposit Insurance Corporation protects people from losses. Used to be up to $250,000, which is not a lot. You know, a lot of our retired or semi-retired members have a lot more than $250,000 in their accounts. But the protection is there, and I think that Biden was talking about providing protection. Doesn't matter to what extent the losses amount. So there's some security in that, significant security in that. But the reserve requirements in Switzerland are much different than they are in the United States. Yeah.
Well, it didn't help Credit Suisse to, although the chairman today had on CNBC, he said that it's very solid balance sheet. There's nothing to worry about it. But the perception was that there are some kind of problems, and it went down today as much as, I think, 25%, which is highly unusual for a bank of that magnitude as Credit Suisse. But still, so it's kind of challenging time on the markets, and many people, some will jump back to buying, some people will wait until it will stabilize, and the only thing is, what I'm thinking is that maybe that calamity will affect decision making of Federal Reserve about hiking interest rates higher and higher and higher, because there are obviously some problems that could be inflicted just by that. Because a major problem is what affected this California bank Silicon Valley Bank is exactly the rising interest rates. They were locked in the long-term treasuries, and they started to lose $1 billion a day or with each interest rate hike. So maybe
couldn't they see that when interest rates were close to zero, or in fact zero, could they not see that there was no place for those interests to go except up? Interest rates, when they were just a few years ago at close to zero, they could only go up. What happens to bonds when interest rates go up? And so why couldn't they see that? These are very capable and well-trained, educated, and knowledgeable people. Why did they let that happen?
Well, apparently all of them were fired, and the word on the street is that they were not that knowledgeable and experienced people, that they were reckless, and the fact that they didn't have for a long time a risk manager, well, seems to me that it's incredible. Or maybe being associated with all the leading venture capitalists like Peter Thiel and others, they thought they're insulated from any calamities, and apparently it didn't work.
Well, there is this idea of the rules don't apply to me, I'm too smart for the rules. And unfortunately, that tends to bite you more often than reward you. And over the long term, it's almost always a death knell, which is why you have to, when you're talking about financial institutions, err on the side of risk management rather than taking risks to get more profit. That, go into some other business if that's your nature. If you're going to take people's life savings and have them entrust them to you, it takes a certain type of character to be in that position. And if your character is to go for the gold and not make sure that the security and safety comes first. We always talk about preservation of principle, and this is the thing that they forgot.
Well, it's interestingly enough, today is mid-March, right? And remember what I said in the last program, at the end of the March, there is a window dressing, there is bonuses to be paid. So in order to do that, the market has to go nowhere but up. Not on a day like today, that's impossible. Although I don't rule out the possibility that it may go higher at the end of the day, because most of the margin calls have to be paid by 1 o'clock. And I remember in old days, when you had margin call, you could call your broker and say, "Oh, I need two more or 3 more days. I have to go to another bank. I have to get my deposits or so on. Could you wait?" and so on. Today, with all the electronic transfers, they won't even talk to you. It's a margin call payable by 1 o'clock. Oh, you didn't pay, liquidating your position or
Well,
position.
however bad the day is for the market and for you individually, it was worse for Julius Caesar. It's the odds of life.
Absolutely. So the thing is that, as I said, in my core portfolio, I don't have margins. I don't have anything.
Yeah.
So I really don't care as long as the dividends are there. So all I have to do is at the end of the month, just to see what are my dividends, get the check out. If I prefer, actually, I haven't got checks out for last, probably 9 months. So probably by the end of March there will be some nice amount which I will take out. Yeah.
Banks, Wall Street banks have changed their margin requirements quite frequently without any knowledge, and you don't know how that's going to affect you. Really, nobody should have a margin account except maybe in the fund portfolio, and be prepared to lose a great deal over there.
Absolutely. Yeah.
Because the brokers have to protect themselves. That's why they have these margin requirements. Sure. Warren Buffett told an interesting story some years ago about a lady who didn't trust banks, and she put her money inside her mattress. Mm-hmm. And then her kid decided she needed a new mattress.
Uh-oh.
So they took this mattress that had money in it and took it to the dump, and hoping that she will be pleasantly surprised when she comes home and finds a new mattress in place. So there you go.
Nothing safe.
Nothing safe. Yeah.
Yeah.
No, you just talk about probabilities, and they're on the side of preservation of principle. I think that's wise. But we talked about the semiconductor industry. I did, and about it's now a national security issue, and therefore I started to look into the sector. This gets into where you can use your intelligence, because in semiconductors you would usually think of Intel, AMD. But those are not the companies that I went into. I went into NVIDIA. I went into Taiwan Semiconductor Manufacturing. And the reason is that they are more modern looking. And that's where your investment will pay off. And Intel and ADM, we're talking about the past. So you can make that intelligent choices in stocks, in individual sectors within these that some are going to have a better future than others. So you can study these and make some intelligent decisions that increases your chances. But again, fundamentally, don't be spending your grocery money buying these stocks. You want to be able to have discretionary funds at your disposal, because even if you make the intelligent call, who knows what could happen? China could invade Taiwan tomorrow, and I could lose everything that I've invested in Taiwan Semiconductors.
Do you disagree with David Svensson, who managed the Yale endowment, the most successful university endowment ever in history, when he said that your prospects of beating an index fund after fees are close to zero? That is, buying an index fund which tracks the U.S. economy as a whole, such as SPY, is virtually unbeatable, except by picking the right stock, which can only be done with hindsight.
Yes, I disagree and agree, because most of my portfolio is index based or something like that. We're talking about a fund portfolio.
Right.
And when you're going to be talking about your fund portfolio, you're going to take more risk than you would.
Right.
So you're not playing the odds of a long-term investor like Yale would, managing Yale's investments would. Yeah. Right, so it's not the same. We're comparing apples to oranges a little bit.
No, that's true. Could people do very well without having a fund portfolio?
Oh, I think
they will have no fun. Number one. Number two. Number two. It does not guarantee that you will not go to the red.
Well, we used to talk about, and we talk about it too, but we don't use the same terms like widow stocks. That used to be what we called them when you your husband would die, and so your financial analyst would say, okay, we're going to put you into stocks that were going to be around forever and pay a dividend.
In Canada, it's Stock Bell Canada. It's #1 widow stocks.
Yes, and so then you can sleep at night. You don't have to worry. Mm-hmm. This is not something where you're going to.
When I was in practice, I had several patients who were in that position. Their husband died. They inherited a large portfolio, and it was all dividend stocks, and they paid no attention to where the stocks went as long as those checks kept coming in on a regular basis, and they did. And so, the dividend aristocrats or stocks, there'd be about 40 or 50 of them that have paid an increasing dividend every year for more than 20 years.
The only comment that I have, I pity her husband, who is a fool to die, not to spend this money to the world, to travel. He would just die. That's a horrible, horrible scenario. And I don't feel for his wife who inherited all this money and put money. Actually, for her, the best strategy is to put this money in a mattress and spend as it goes, travel here and there, buy certain things here and there, and forget about all investments at once.
I love the will that said, being of sound mind, I spent it.
But this is an art, how to spend your money while you're still alive without overliving that. So let's see, if you think, okay, my time horizon is, okay, say 95 years old. What's happened if you live up to 96, 97, and you already spent most of the money, and now you have to worry about the money coming in? But he's already done.
Well, your children look after you, don't they?
Sorry?
In such a case, your children look after you, don't they?
Yeah, that's true. Yeah, and grandchildren too. Don't forget those. Well, gentlemen, thank you so much for today's program. Hopefully next Wednesday
Thank you for inviting me.
Better market circumstances, and we'll discuss it then. Thank you so much. Bye-bye, everybody.
Delighted to be here. Thank you.
Bye-bye.
Anybody else there with me, or am I the only one here? Well, then I will leave the studio also.